34 to 41%. That is the percentage of buy now, pay later users who report missing at least one payment. It's a staggering failure rate for a system marketed entirely around convenience and zero interest.
And look, that 34 to 41% isn't just some minor glitch in the system. It's a massive behavioral trend. When nearly half of your user base struggles to make their basic installments, you really have to ask what's actually happening behind the scenes at checkout.
Because the real-world impact here is severe. Literally, 1 in 4 users between the ages of 18 and 34 are cutting back on absolute essentials. We're talking about skipping groceries just to keep up with these debts. So how exactly did a supposedly helpful tool become such a trap?
Section 1. What is Buy Now, Pay Later? The psychology of checkout. So, behavioral economists have a term for this: payment decoupling. You see a large total price, right? But splitting it into 4 small payments fundamentally tricks your brain. The psychological pain of the purchase just plummets. Add in that instant one-click soft credit approval, and the friction that usually stops impulsive debt, it vanishes entirely.
Section 2. The scale of adoption. A $111 billion shift.
Check out this trajectory. U.S. transaction volume is hitting an estimated $107 billion in 2025, and it's projected to leap to $258 billion by 2031. It's insane. This is rapidly becoming one of the fastest-growing consumer credit products in modern history.
And honestly, it's not just who you might think. We really need to dispel this myth that it's only a crutch for lower-income shoppers. New data actually reveals that high earners are increasingly flocking to buy now, pay later too. It's a universal phenomenon now, mostly driven by Gen Z and millennials, who just want to avoid traditional credit card interest.
Section 3. The hidden debt problem. The danger of loan stacking.
Okay, so loan stacking. This happens when you hold multiple active plans across different apps simultaneously. And because each individual app only sees its own specific loans, your total debt load is completely invisible to the rest of the market. It's basically a massive financial blind spot.
And man, that invisible debt adds up fast. The Richmond Fed recently calculated that there's roughly $3.02 billion in outstanding buy now, pay later debt at any given time. That's a huge pool of financial obligation hiding completely off the traditional radar.
Which, understandably, is causing some panic among regulators. A 2026 industry risk analysis explicitly noted that this lack of transparency increases delinquency risk and creates hidden debt that traditional lenders can't easily assess. Put simply, traditional banks literally have zero read on how financially overextended someone might actually be.
Section 4. Late fees as a business model. The cost of interest-free.
Get this. Almost 7% of the entire buy now, pay later industry's total revenue comes directly from late fees. The whole system is aggressively marketed as free, but a significant chunk of their multi-billion-dollar business model actually requires you to slip up. When you compare the numbers, it becomes painfully clear. The outright default rate is incredibly low. We're talking under 2%. People aren't just walking away from these debts entirely. But that massive 34 to 41% late payment rate, that means users are struggling just enough to be hit with repeated, highly profitable fees without fully defaulting. It's a very specific, very profitable sweet spot. Section 5. The credit score shift. The end of the gray zone. For years, all of this happened in a consequence-free bubble. Back in 2024, it was totally invisible. But then, in 2025, Affirm began actively reporting to credit bureaus. And now, in 2026, FICO is officially incorporating this exact data directly into their scoring models. The game is completely changed. So the absolute crucial takeaway here is this. You have to treat buy now, pay later like any other traditional debt. Your actual credit score is now on the line. The frequent short-duration borrowing activity of these apps could very easily be misinterpreted by traditional scoring models as elevated risk, meaning you could be penalized even if you think you're managing it perfectly.
Section 6. Safe system, risky for you. The macro versus micro reality.
Let's zoom out for a second. On the macro level, the Federal Reserve points out that buy now, pay later is only about 1.1% of overall U.S. credit card spending. So systemically, it's safely contained. It's definitely not going to crash the economy. But look at the micro level for the consumer. For the individual facing hidden loan stacking and 40% missed payment rates, the risk to your personal household is undeniably high. Both of these realities are true at the exact same time. Okay, so how do you actually protect yourself?
Here are a few practical, evidence-based takeaways. First, you have to track your total exposure manually across all your apps because no single provider is going to do it for you. Second, treat it exactly like traditional credit card debt. Third, assume every single transaction impacts your FICO score moving forward. And finally, always apply discount codes before you split the payment. That reduces the actual principal you're financing.
Which leaves us with one final thought. The next time you're staring at that checkout screen and you see that super simple, frictionless Pay in 4 button, just ask yourself, who is really paying the price for that convenience?